Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hello, let's talk about something fundamental to how many Canadian businesses are structured, moving money from your operating company to your holding company. Now, what if I told you that a transaction you might consider routine could now unexpectedly trigger a massive tax bill? Today, we are going to dive deep into Section 55(2) of the Income Tax Act. It's a rule that has truly changed the game for private corporations in Canada, and understanding it could save you from a very, very expensive surprise. So here's our roadmap for today. First, we're going to look at the pretty clever loophole that started this whole thing. Then, we'll examine the government's powerful response and the two crucial tests that it relies on. We'll also uncover the main escape hatch, the one that pretty much everyone is scrambling to use now. And finally, we'll get to the real heart of it, the recent changes that are forcing every single business owner to rethink their corporate strategy.
All right, let's get right into it. To really understand why this rule even exists, we have to travel back in time a bit, to the problem it was designed to solve. And it all begins with something many business owners think about, eventually selling their company.
Let's paint a picture. Imagine you have a holding company. We'll call it Holdco, and it owns your active business, your OpCo. Now, your OpCo has done very well, and it's worth, let's say, $1 million. To keep the numbers simple here, we'll just call it $1,000. And your initial investment, what we call the adjusted cost base, was only $100. So you're sitting on a very nice but very taxable gain.
So you find yourself at a crossroads. You could take the direct route. Sell the OpCo shares for $1,000. That leaves you with a $900 capital gain and, of course, a significant tax bill. Or you could try what financial planners used to call the creative or smart route, a strategy designed to make that tax bill basically vanish.
So how did this magic trick work? Well, it was a three-step dance. Step 1, right before the sale, your OpCo pays a big $900 dividend up to its parent Holdco. Now, this is the key. That dividend is usually tax-free when paid between two Canadian corporations. Step 2, paying out all that cash reduces OpCo's value from $1,000 all the way down to $100. And then, Step 3, Holdco sells the OpCo shares for their new, much lower value of $100. The result? Zero capital gain. And this maneuver has a famous name. It's called capital gain stripping. You're literally stripping the value out of the company using a tax-free dividend to avoid paying tax on a capital gain. Now, as you can probably imagine, the government was not a fan of this. And back in 1980, they introduced a very powerful rule to shut it down for good. And that brings us to the government's response. Their weapon of choice, Section 55, subsection 2 of the Income Tax Act.
In the simplest terms, this rule is designed to look at the exact transaction we just walked through and basically hit the undo button. It takes that dividend, the one that was received completely tax-free by the holding company, and it recharacterizes it. It says, nope, that wasn't a dividend, that was a capital gain. It effectively puts the tax bill right back where it was supposed to be. Now, here's where the mechanics get really interesting. You see, the law treats a regular cash dividend differently from something called a deemed dividend. A deemed dividend can happen, for example, when a company buys back its own shares from you. To the taxman, that transaction isn't a sale, it's a dividend. And this little distinction creates what one expert called a fascinating legal round trip. Let me show you how this round trip works. First, when your company buys back its own shares, a rule called Section 84(3) kicks in, and it says, hold on, that's not a sale, we're deeming this to be a dividend. So, poof, your capital transaction has magically become a dividend. But then, almost instantly, Section 55(2) steps in for corporate groups and says, not so fast. It grabs that deemed dividend and turns it right back into a capital gain. It's a perfect, seamless loop, all designed to make sure the original tax on the gain gets paid.
So here's the most important part. For this powerful anti-avoidance rule to actually apply to you, a transaction has to check 3 specific boxes. All 3. First, there has to be a tax-deductible dividend between corporations. Second, it has to meet one of 2 key tests. And third, it has to fail a test related to something called safe income. So let's zoom in on that second condition, because this is really the heart of the matter. It all comes down to 2 very different tests, the purpose test and the result test.
I want you to think about it this way. The result test is like a security camera. It's totally objective. It applies to those deemed dividends from share buybacks, and it just asks a simple question.
Did this transaction result in a lower capital gain? It's a straight yes or no. The purpose test, on the other hand, is more like a detective. It's subjective. It applies to regular old cash dividends, and it's trying to figure out your intent. It asks, why did you do this? Was one of the purposes of paying this dividend to lower your tax bill? And this quote just brilliantly illustrates the central debate. Look, almost every single time a company pays a dividend, it will, by definition, reduce the value of that company's shares. That's the result. But what the law says is, that's not the point. The real salient issue is, was that the purpose? And this is precisely where it gets tricky for so many business owners. Think about very common, legitimate corporate strategies. Maybe you move cash up to your holding company to protect it from potential lawsuits against your riskier operating business. We call that creditor proofing. Or maybe you move some non-active assets out of your opco to make sure it qualifies for the lifetime capital gains exemption. That's called purification. Now, these have clear business purposes, right? But the tax authorities might now argue that one of the purposes was also to reduce the value of your opco shares, and that puts you squarely in the danger zone. So let's say a dividend fails the purpose test. You paid it, and one of your reasons was indeed to reduce a future capital gain. Is it game over? Is the transaction automatically reclassified? Well, not necessarily. And this brings us to the main escape hatch, the safe income exception. So what on earth is safe income? The easiest way to think about it is like this. Imagine your company has a big piggy bank where it has been saving all its after-tax profits since it started. That's its safe income. It's the money the company has genuinely earned through its real business operations, not through any clever tax engineering. It's the safe money. And the rule here is, in principle, beautifully simple. As long as the amount of the dividend you pay out does not exceed the amount of this calculated safe income, then Section 55(2) does not apply. You're in the clear. The dividend can be paid tax-free, even if one of its purposes, technically, was to reduce the value of a share. Okay, so this brings us to the present day and why this entire topic has become so critical for corporate planning. Recent legislative changes have completely altered the landscape, making that safe income calculation more important than it has ever been. Let's just quickly break down what changed. First, the purpose test got wider, so it now catches even more situations. But the real bombshell was the gutting of something called the related party exemption. Now, this used to be a kind of get-out-of-jail-free card. As long as you were just moving money around between your own companies, you were generally safe. Well, that card is now gone for most dividends. And the bottom line of all this, safe income is no longer a footnote in the tax code. It is now the main event. It is your single most important line of defense. And this presents a huge practical challenge, because calculating a company's safe income isn't just a matter of looking at last year's profit. Not at all. It is a cumulative, historical calculation that requires detailed financial records going all the way back to the last major tax reform in 1971. So what does all this mean for you as a business owner? It means you have to stop thinking of dividends between your companies as simple, routine transactions. They're not anymore. That standard creditor proofing or purification plan your advisor set up for you years ago, it now comes with a huge warning label. Before you move any significant amount of money between your companies, you absolutely must do the math on your safe income. The stakes have just become too high. So I will leave you with this one critical question to think about. With these new rules and all the uncertainty that follows, is your standard corporate planning still safe? Or could you be sitting on a ticking tax time bomb without even knowing it? It's a question you really need to discuss with your tax advisor before you make your next move. Thank you for joining me.